The three standards of MFRS which apply by Genting Malaysia Berhad is MFRS 9, MFRS 15 and MFRS 1. First and foremost, MFRS 9 replaced MFRS 139 and amongst the previous requirement in three main areas, which is classification and measurement of financial asset, impairment of financial asset mainly by introducing a forward-looking expected loss impairment model, and hedge accounting including removing some of the restriction on applying hedge accounting in MFRS 139. Other than that, with the adoption of MFRS 15, revenue is recognized by reference to each distinct performance obligation in the contracts with customer. Transaction price is allocated to each performance obligation on the basis of the relative stand-alone selling price of each distinct good or service promised in the contract. Depending on the substance of the contract, revenue is recognized when the performance obligation is satisfied, which may be at a point in time or over time. The group has applied this standard retrospectively and has elected the exemption in MFRS 1, not restate contracts that were completed before 1 January 2017. Moreover, as provided in MFRS 1, first-time adopter of MFRS can elect optional exemptions from full retrospective application of MFRS. The group has elected the exemption of property, plant and equipment, previous revaluation esteem cost exemption under FRS, valuation adjustment on certain property, plant and equipment were incorporated into the financial statements. The group has elected to use the previous revaluation esteem cost under MFRS. Accordingly, the carrying amount of this property, plant and equipment as at 1 January 2017 have not been restated. The revaluation reserve of Rm 2093 million as at 1 January 2017 was reclassified to retained earning. First and foremost, the cash flow statement of Genting Berhad Malaysia show that the net cash flow from operating activities in year 2018 is 455.7 million more than year 2017. This tells us that the cash of this company generated from its core business operations of year 2018 is more than year 2017. The net cash flow from investing activities for both years are negative value. A negative cash flow is often indicative of a company's poor performance. However, as we can see that the company had paid effort to recover some compared to year 2017. Moreover, the amount of net cash flow from financing activities of year 2018 is less than year 2017. This section is showing the flow of cash that are used to fund the company. The differences between both years is that in year 2018, the company has bought back their own shares and therefore it would make some changes between these 2 years.
My name is Lee Wan-jun. I would like to introduce three standards of MFRS that the company Sime Darby Berhad comply and the purpose of complying with this standard. The first one is MFRS 9. MFRS 9 replaced the MFRS 139 that the company complied before. The standard introduced the new requirement for the classification and measurement, impairment and hedge accounting. It is also introduced an expected credit loss impairment model that replaced the incurred loss impairment model that the company complied before. The second one is MFRS 16. MFRS 16 set out the principle for recognition, measurement, presentation, and disclose of risks. This standard introduced a single lessee accounting model and require a lessee to recognize assets and liability for all leases with a term of more than 12 months, unless the underlying assets of its low value. Third one is IC Interpretation 23. It provides guidance on how to recognize and measure the deferred and current income tax assets and liability where there is uncertainty over a tax treatment. If it is not probable that the tax treatment will be accepted by the tax authority, then the effect of the tax uncertainty should be included in the period when the determination is made.
According to the net cash from operating activities, which stated in the statement of cash flow in 2018, it is positive value but it shows negative value in 2018. The difference is there is a negative value in the trade and other payable account. A decrease in trade payable would indicate that more cash being used to pay off bills and less was generated by operation. Changes in working capital show an increase and decrease of certain current assets and liabilities. At first, the cash flow statement begins with net income, which is equal to the profit reported on the income statement. It shows a decrease in the net income from 2017 to 2018. The decrease in net income also reflects the sales and expenses of the company's operating performance decreased from 2017 to 2018. In 2018, from the investing activity, it shows a positive value at the net cash from investing activities. It can be clearly to identify that the company has sales of fixed assets and investment securities. It shows a big difference between 2 years and there is a big change from year to year.
The company I have chosen is Digi Telecommunications Sendirian Berhad. There are 3 standards of MFRS applied by Digi company, which is MFRS 9, prepayment features with negative compensation, MFRS 128, long-term interest in associate and joint venture, and MFRS 16, lessors. The objective of the standard of MFRS 128 is to prescribe the accounting for investment in associate and to set out the requirement for the application of the equity method when accounting for investment in associate and joint ventures. The amendments to MFRS 9 financial instrument allows company to measure prepayable financial assets with negative compensation at amortized cost or at par value through other comprehensive income if certain conditions are met. For lessee accounting, MFRS 16 applies a right of use approach which requires a lessee to recognize assets and liabilities for the right and obligation created by lessee contract. Assets and liabilities arising from a lease are initially measured on a present value basis. As a consequence, a lessee recognizes depreciation of a right of use asset and interest on the lease liability. Operating cash flow before working capital changes in 2018 is higher than in 2017. It is because of the fair value gain or loss on derivative financial instruments. The gain or loss on the derivative generally offsets the loss or gain on the risk exposure. It shows that in 2018 there is a loss on the risk exposure compared to in 2017. Next, an increase in accounts receivable hurts cash flow, while a decrease helps cash flow. As shown in the statement of cash flow in 2018, the trade and other receivables increased, while in 2017 it decreased. Cash does not increase until the business collects money from its customer. In the statement of cash flow from investing activities, the purchase of intangible assets in 2017 is higher than in 2018. Hence, it causes the net cash used in investing activities in 2017 show a higher amount compared to in 2018.